Most small business owners are doing tax preparation completely wrong, costing them unnecessary money and stress. In this video, I'll show you the right way to do it so that you can keep more money in your pocket and have less tax stress. Tax preparation shouldn't be a surprise at all. It should be a check mark. You're just crossing it off the list. Your tax preparation starts about a year sooner than what you're doing right now. Tax deadlines are known. They're March 15th and April 15th. If you file an extension, they're September 15th and October 15th. These are the same dates year after year, unless there's some extraordinary event like COVID, in which case we know in advance it's being moved out to another date that's again known in advance. When you have a fixed date, that allows you to do a lot of planning in advance to avoid unnecessary surprises. The part of avoiding unnecessary surprises is realizing that tax preparation is not tax planning. Those are two entirely different things. Tax preparation is reporting to the IRS what you did for the year, a reconciliation and a calculation of the taxes that you owe compared to how much you've paid in taxes. And if there's a difference, you get a refund or you have an amount due. So it's entirely a reconciliation and a reporting event compared to tax planning, which is a strategic thing that you're doing based off your goals to find ways to pay the least amount in tax legally required. In order to do tax planning properly, that has to start during the tax year. Once the tax year is up, almost every tax planning opportunity goes away. And so there's this myth that when my CPA or my tax preparer is preparing my return, they're reducing my tax liability. In a way they might, because they might bring to your attention things you weren't aware of. But again, they're really just reporting on what's already happened. Tax planning is about strategically finding those opportunities and executing on them to fund your goals faster. As part of this planning, you need to know your effective tax rate. And to find that out, you can project your income out based off your wages and your business profits, add that all together. And then you can go Google tax calculator 2024, or whatever year you're in, tax calculator 2025. And you're gonna find a bunch of different online tools where you can type in your taxable income and hit enter, and it's gonna give you the total estimated tax and what marginal bracket that you're in. Now, what I recommend is that you take that rate and each month you multiply your profit times that rate and at least put that money aside into a separate account. Then when you do tax planning and that amount gets reduced and we've lowered your tax bracket, the money you have in your savings account becomes a windfall. That's money that you can now repurpose towards your goals. That's not what I see most small business owners doing. They're waiting and praying and hoping that their tax return comes back with a refund or some number that they magically have enough to pay it. And so when their tax bill gets reduced, it's not a windfall because oftentimes they didn't have that money set aside to begin with. Real quick, if you're watching this video and you're thinking, Dan, how could you be my CPA and we could do this all together? Well, go down to the pin link below, or the description below, click on the first link. That's gonna take you to my website where you can schedule a quick call and see if it makes sense to work together. Now let's get back to the video. The fact of the matter is you're not a tax expert, but you do know your business better than your tax preparer does, really better than anyone knows your business. And just like a nice car, nice clothes, home, details matter. And details especially matter on your tax return because how transactions get reported impact their deductibility. Let me give you some examples from clients that I've worked with in the past. One example is a band manager. And they have a bunch of expenses going to concerts so that they can both learn about what's happening in the music space, but also potentially recruit other bands to be under their management. Now, currently under the tax code, if I were to go to see a concert, that would be considered entertainment and would be 0% deductible. But for a band manager, that's research and development. And so if they recorded it as entertainment, 0% deductible, they recorded it as research and development, 100% deductible. So the way things get coded matter. And not only do they matter in terms of the deductibility, but they also reduce your risk. Because things like entertainment, meals, travel, those are things that are often abuse areas, and so they're more scrutinized by the IRS. But if they're not actually a meal or a travel expense, but they're research and development, or they're an event expense, or they're a marketing expense, now not only have we increased the deductibility, but we've also reduced your risk profile by properly characterizing the transaction. Your tax preparer who's just seeing the information on a P&L, they don't have the context. And so they're just going to prepare your return accordingly. Also, to the point that the details matter, there's some small nuances that I often see missed on tax returns. For example, there's a 6-digit code to describe your business. And that 6-digit code is often ignored, and they're just a general code that's picked from a drop-down, not a whole lot of strategy by the IRS. But I've had clients that have come to me because their returns are being scrutinized by the IRS based off the code that they've selected. And the IRS is saying, hey, we don't think you qualify for this 20% pass-through deduction. That's limited if you're a service-based company. It's not limited for non-service-based companies, but based off the code that you've selected, you sound like you're a service-based company, but in fact, they weren't. And so now they're getting scrutinized, and the IRS disallowing a 20% deduction, meaning excluding 20% of their profit from tax because the code was selected wrong. Additionally, it can impact lending decisions. So completely separate from the tax decision, a lender is going to look at that 6-digit code, and they're going to determine whether or not they think you're going to meet their risk profile based off that code that you probably never even looked at before. Those details matter, and your tax preparer has to understand your business and your goals to make sure they get it right. Oftentimes, I see between $60,000 and $100,000 in low-hanging fruit missed opportunities because the tax preparer didn't have enough background and isn't working closely enough with their client. Let me give you a couple examples. One, a business that should be taxed as an S corporation is being taxed as a sole proprietorship. A sole proprietorship is taxed the way that wages are taxed. They are subject to the federal income tax, which are those brackets I was talking to you about before that you could use a tax calculator to figure out. They're also subject to FICA taxes, or what's also referred to as self-employment tax. This is 15.3% tax on the first roughly $180,000 in income, and then it goes down to 2.9% thereafter. If that business was converted to an S corporation, then the business owner would have an obligation to pay themselves a reasonable salary. That reasonable salary would be subject to the federal income taxes and be subject to the self-employment taxes, but any profits left over thereafter don't get that self-employment tax, that 15.3% tax. So properly setting up the entity makes a huge difference in terms of tax. Something I've also seen repeatedly is the improper reporting of short-term rentals, oftentimes because the tax preparer doesn't even know that the rental is a short-term rental. About 5 years ago, the IRS clarified the rules for short-term rentals, and they said short-term rental is a rental property where the average stay per tenant is 7 days or less. And if that's the case, then it likely should be recorded on Schedule C as opposed to Schedule E, where most rental properties are reported. Schedule C is for a trade or business. Schedule C is for long-term real estate. The requirements to deduct losses from long-term real estate are significantly higher than short-term rentals. And that can be the difference between being allowed to take a $50,000, $100,000, several $100,000 loss and not. Not too long ago, I was working with a client who jointly invested in some short-term rental properties, and their partner was handling the tax preparation, and the CPA came back and they reported on the schedule. Now that was a huge issue for my client because it meant they weren't going to be allowed to take about $200,000 in losses, which would have been worth about $80,000 in tax savings to them. And so we pushed back, and the CPA was like, no, it goes on Schedule E. We showed them the specific rules from the IRS, and finally we got them to amend the return, but it also meant they had to amend about 200 other returns they had prepared that year alone, where they put the short-term rentals on the wrong schedule. Details again matter. Reporting things on the right schedule matter. Lastly, there's something called the de minimis safe harbor election. This allows you to limit some risk with the IRS and be able to directly expense things that you might otherwise be required to depreciate. And so it's a way to, again, eliminate risk, but get some tax deductions now. We record the de minimis safe harbor election on every return that we prepare, because if you don't put it on a timely file return, you can't amend and add it later. And this is something that I see missed 9 out of 10 times, 99 out of 100 times. They're missing this de minimis safe harbor election. They're missing an opportunity to limit risk on their client's behalf. Details matter, and you have to shift the way that you're working on your taxes from something that's kind of an afterthought where your CPA is checking some boxes for you to something that is part of a broader strategic perspective.